Vamos a analizar el mercado, lo vamos a hacer con Teresa Keane, que es Managing Director de Alliance Bernstein's Equity Business. Teresa, good afternoon.
Good afternoon.
We are halfway through the year 2024. Teresa, can you comment on the overall economy and the performance of equity so far this year?
Yes, of course. So good afternoon. So essentially, the global economy remained unchanged this year so far. It proceeded really along the lines that we expected. While there is some evidence of a slowdown in growth, actually that's quite welcome because it's actually contributing to disinflation and to that downward trajectory of inflation that we need. It's also essentially bringing the economy back into balance and also allowing central banks to cut those interest rates significantly. And then if you look at the left-hand side of the chart, you can see that actually financial assets really benefited from this environment. Global equities, as measured by the MSCI World, were up 11.7%. US equities, on the other hand, were up 15.3%. And then on the right-hand side, you can see that strong performance year to date was really driven by technology and communication services. The weaker sectors and industries of the market year to date included the likes of consumer discretionary, some defensive such as consumer staples, but also commodities. Now, it may look like nothing has changed from the first quarter, but really what we're seeing is the mega caps are still outperforming. They are no longer behaving as a consistent group. Nvidia is still towering over the market. Tesla and Apple did decline. But all in all, in terms of the economy and equities as a whole, it's fairly resilient, but it has also been a fairly bumpy year-to-date period, which we're clearly going to see some more of. The VIX was low and realized vol was low, so it'll be an interesting couple of months going forward.
Mm-hmm. Although equities, Teresa, have proved resilient, there are still significant tail risks. How do equities perform in the current and lower inflationary environment?
Yeah, it's been a very interesting market environment. Equities have performed strongly, financial assets have performed strongly, but it's been a very challenging macroeconomic backdrop that we've been managing to. And in fact, in a recent global fund manager survey, when investors were asked what were the key risks that they're really concerned about, high inflation was really top of that list, as you can see. Geopolitics and the US election clearly are ongoing, and these risks are likely to remain very elevated over the next few months. And clearly we've been managing these risks for some time, so all of that is taken into consideration into the management of our portfolio. But coming back to that key risk of inflation, and when we look at equities and how they generally perform in inflationary periods, if you look at the chart, you can see that in inflationary periods, and when inflation is running, we'll say between 2 and 4%, generally equities have performed quite strongly, delivering a real return of 8% on a rolling 5-year basis. And then if inflation moves down to that lower target, we'll say of 2%, generally equities do perform also very well, 11.7%. So over history, that's clearly what I'm showcasing here, performance of real returns of US equities over the past 100 years. So we believe ultimately that equities are needed to deliver that real return over and above inflation, as well as which will enable investors to achieve those financial goals over the long term.
Mm-hmm. Teresa, you mentioned the Magnificent Seven earlier. Can you comment on valuation and in particular the outlook for the rest of the year?
So in terms of the Magnificent Seven and what we're seeing, valuation clearly is a key risk today, and it continues to do so. The Magnificent Seven are trading at peak valuations. When we look at price forward earnings, the current premium is around 75% for those stocks. The average for a 10-year premium is around 36. So you can see why we consider price to be a key risk today, followed by earnings risk, and then followed by rate risk. And we should point out, though, that the AI enthusiasm is not a bubble about to burst, mainly because there's real earnings behind these companies. These companies are high quality companies generally. And generally, when we look over over to the second half, what are we seeing? We're seeing convergence on the earnings growth between the Magnificent Seven and the rest of the market. And we are actually finding opportunities, high quality companies, outside of that cohort of companies. We're finding opportunities in healthcare, digital payments, but also within the European industrial sector, where we're finding surprisingly consistent growth in the current period. And so all in all, we're looking for these characteristics of companies of quality, stability and price in order to navigate this market environment.
Mm-hmm. Last question, Teresa. What are the characteristics of the companies you're looking for? Why are they important in the current environment and over the long term?
Well, the characteristics of companies that we invest in right now and actually over the 10 years of managing this strategy are very much around quality, stability and price. So we like those high quality companies that profitability metrics, we look at our return on assets, return on invested capital. We like those companies that have consistent revenue streams. And you can see that reflected in the characteristics of companies that we're delivering on here. In terms of stability, we like to invest in those companies that are less susceptible to wide market swings. So in terms of beta, you can see that we have much lower beta than the broad market as a whole. And then in terms of price, we're looking at price to free cash flow. Clearly, price will always be attractive. We want to avoid that crowded trade because such stocks generally disappoint and can be vulnerable in periods. So those are the overall characteristics of companies, quality, stability and price, which will ultimately deliver the pattern of performance that we're seeking to deliver to our clients over the long term. We're seeking to participate when the equity market is rising, but mitigate risk when the market is falling, thus enabling our investors and clients to stay invested during uncertain periods. And we believe clearly that the last 10 years was actually, we saw fewer downside events in the last 10 years. The next period is certainly going to be a little bit more volatile. So that's why we've been tested over the past 3 years in terms of the design of this strategy, but we've proved that investors can stay in the market, enabling to participate in the market as well as mitigating that risk on the downside during uncertain periods.
Teresa Keane, Managing Director at AllianceBernstein's Equities Business. It's always a pleasure to have you here join us in Negocios Televisión. Thank you so much.
Thank you very much. And I just want to say congratulations to Spain on Wimbledon win and, of course, the football as well. Thank you very much.
Thank you. Bye. Thank you so much, Teresa.